I paused the recording.
Okay, all set up, Carson, your host again.
Okay, I just
Except to get the YouTube live going, it takes a little finagling.
yeah, I know. And
All
I
right.
just wanted you to know that I paused the recording because I opened it up at like 17 minutes before.
Oh, yeah, we don't even need the recording now because it'll be on.
That's what I thought.
We'll
Yep.
pull it out of YouTube.
Yep.
Okay.
That's what I thought. And I don't know why my image is all blurry, but I'm not the speaker, so I guess
It's probably your camera screen. You might want to wipe it.
not with that. We'll get. I don't know. Wild, something got on there.
Probably a fingerprint.
Yeah, something. Somehow I grabbed it apparently. Oh, there he is. Oh, we could use a new picture for Pat, but then mine on Zoom is probably even older.
Good morning.
I got out of the car and got back set up because I kept getting delayed by calls and emails. But
Good.
I guaranteed that my multi-transaction family was going to get complicated, and it certainly has.
Is what's her name? Anna? Is that her name?
Yes,
Ibai?
yes.
Yeah.
We're in an inspection period,
Okay.
and
Close to where her former house was?
not too far. Yeah, well, it's actually closer to where her husband has bought a house, so that's probably the best thing.
We're live on YouTube, guys. Remember.
Oh, sorry, no names. Good reminder. Pat was very supportive to go out and show some houses a couple times.
Good to see her find something.
It'd be fun to have a conversation with you and Jackson about what's going on at the national level.
With Jackson Pino?
Well, with both of you.
What do you mean going on at the national level? You're referring to the trial or what?
The MLS participation, not the trial stuff.
You know, interestingly, we were just talking this morning about forms and access to state forms. You know, with North Dakota just coming out with new forms and requiring membership or a cost or whatever to access them. And the concern with the Minnesota Realtors AEs is that they're getting access, the North Dakota agents are getting access to Minnesota forms for free, as are Wisconsin. And if there's a cost, you know, if you got to be a member of North Dakota to get the forms, that we may lose membership going over there. So that's a concern.
Pat, you tried to raise my blood pressure already.
Yeah.
Man. Well,
Yeah, I mean, that's not a good time to try and enforce something like that.
Yeah. I will be back in a minute.
I was only looking for a writing utensil. I didn't used to have that feature. That's good.
Which feature?
Blur my background wasn't.
Oh, yeah.
You don't have very much time left, Nick, huh?
Thursday night,
Yeah.
next Thursday night, 27th.
And I realize again we're recorded.
It's public knowledge.
Yes. Yes.
Should I leave captions on or should I turn them off? Some people like them.
Captions.
Do you not? Oh, do you not see that on your side?
No, I'm looking. You're not talking about chat.
No, there's a captions function. It must be only for each user. I thought it maybe was for the entire meeting. I'll just hide captions.
Interesting. Oh, is that like if a host wants to add a note or?
No, if you go to the bottom of your toolbar in Zoom and click show captions.
Maybe I don't have that option.
You don't. It should be right next to the record button. Participants chat, summary, AI, record, captions.
It's in a drop down.
Oh, okay.
That's inclusive concept of yeah, we have used that on occasion where the speaker it all closed captioned, yeah.
Yeah, the YouTube live will process captions after the fact. Like if someone were to watch it later, it'll have captions automatically, but you know, each user has their own option now, so that's fine.
Gotcha.
Okay, I'm gonna mute and stop video. I'll just sit in the background. If you need anything, text me.
I will.
And I'll do what I can.
I will.
Okay.
We should be ready. All right.
Hello, Scott. Greetings, Scott.
Yes, welcome, Scott.
Hey, Pat. Morning, everybody.
Here's Tom. Good morning, Jackson.
Good morning. Can you all hear me just fine?
Yes.
Yes, we can.
Good.
Wonderful.
Can somebody make Jackson a co-host?
Yeah. He's already set. He can share.
Yeah, I think as soon as you stop screen sharing, I'll be all set.
We don't have any.
Yep.
Mr. Shipman. It's been so long. Good morning, everyone who's joining. It is 10 o'clock. We start in just a couple minutes as we have people sign on. I found I could blur my background for the first time. Started out with everything blurred. But then I'm not the speaker. Jerry, let's get Jerry in here. So I'll be hosting in the background and getting people in and making sure that we have a quiet time for the presentation. Everyone knows the usual protocol. We'll put questions in the chat to review.
Is the sound on? I'm not hearing anything, and
Are you hearing me?
I can hear.
Are you hearing me, Pat?
Yes, I can hear everything. So
Okay. Okay.
Good morning.
Yeah, it's all on. Just people are mostly muted, Pat, which is fine until they need to speak. And
Good morning, guys.
good morning, Jerry.
Good
So
morning.
after all these years, the Zoom system sort of kind of works. I do miss your big airplane headset, Jerry.
and Jerry, congratulations on your green designation.
Thank you, as well as Carson and
And Todd,
Todd. But thank you, Pat.
that was a full house. We proved the classroom can only do 50 people, I think. I remember when it was laid out, Jerry, it was said to be able to max out at 55, and I thought, wow.
We pushed the limits.
Yeah. Yep. Well, we will get started in about 1 minute. Good. Here's Natasha coming in, Pat.
Yes.
So this has been a quarterly thing for at least 15 years, hosted by Exit Realty Metro, and where I am managing broker, and always pleased to have my esteemed colleague and stats geek Pat with us. And now we have the pleasure of having Jackson Pino, our public affairs manager and a data geek from the industry, from Pat in the industry and practitioner, and Jackson in the overall, looking at the big picture from a staff perspective. So I think the balance is a very good thing. And where there's time at the end of the presentations, they each present a segment. We then have questions and answers and some topical things that we can get to. We run this for 1 hour and 15 minutes so that you know the schedule. We don't like to drag on when we're all in the Zoom world. And one last time, if you have a question or a comment, please put them in the chat and we will make sure we get to those. There's been times when Pat and Jackson have answered and followed up with data or questions that people might have. Because it seems like every time we do this, there's something interesting going on in the industry where it's like, wow, I can't wait to hear what the projections and predictions, depending on their viewpoint, might come up. So let's see if I think I've got everybody all logged in here that's available.
I think we're ready to start.
Yeah,
Carson.
it's Pat. It's October of 2023, and this is normally a big slowdown period. But did it have anything to slow down from, or was it? How was the summer? And let's take a look at what's going on.
Thank you, Carson. And thank you to everyone that has joined. And that would include everyone that's watching on YouTube. We can't see who you are, but we thank you and welcome you. So I'll do a slideshow presentation followed by Jackson Pino. And I think combined, we've got 50 some slides, so we'll just kind of move right through it. We ask that everyone stay muted. Please, if you have questions, and we highly encourage them, please put them in chat, and we'll address them when we're done with the presentation. So I'm going to get started. October 2023, there's a lot going on. My presentation is going to cover like 3 sections. The first one, inflation, interest rates, and affordability. Something that I'm not an expert on, but since I watch the market constantly and it has such a huge impact on the real estate market, I'm always reading and taking interest in and following, and certainly have an opinion with regards to that stuff. We can't have a discussion on the market without really focusing in on, in this current time, interest rates and inflation and the affordability challenges. Then I'm going to have current market data slides in the middle, and then some important national slides covering national insights and trends. So starting out, inflation and interest rates are playing an outsized impact on the market. At the same time, this encounters strong, long lasting or trends that have been around for a long time that are demographic. And the other one, of course, is we've underbuilt homes for at least 15 years as the millennial generation, which is a huge generation of people, are now many of them in their 30s and prime home buying age. So these are significant demographic trends that lead to low inventory and higher demand, and kind of place a floor underneath prices, preventing prices from going lower despite the high interest rates and the low affordability. So inflation, kind of a long view. this goes back to the 1960s, and the current bout of inflation way over on the right, it reached 9% at one point in the blue. The red is the core inflation. And then it started coming down, which is great. Big concern when it's up to 9%. The Federal Reserve likes inflation to be at around 2%. Okay, a little bit of inflation. They don't like deflation, but they don't like inflation that's too high. And it dropped down. It was looking really good. It went down to 3%, and then it bounced up a little bit. So the last 3 months, it's been a little bit above 3%. And the Fed and the actions they're taking that are causing interest rates to go up, they're not really going to fully let off the brakes on this until inflation gets down to 2 or 2 or less. On this chart, you can see way back in the 1970s and early 80s when inflation was really high. And yes, I remember those days. And this may sound kind of funny, but I remember my rent going from $65 a month to $95 to $140. And that just seems so low right now. But when you're making $100 a week, that's pretty high and pretty dramatic. So
Still sounds funny.
yeah. So this is the last 20 years roughly in inflation. And you can kind of see in the red, that's all items. In the blue, that's shelter. Shelter makes up a big portion of the inflation numbers because that's a big part of what we spend our money on, right? And the shelter portion is still high because the numbers they use are kind of lagging. They use them because they're very comprehensive, but we can see other measures of rents and so forth that are coming down dramatically. So we do expect that shelter part to come down in the months ahead. And then hopefully inflation easing down to 2%. Okay, so let's talk about the Federal Reserve and interest rates. So Federal Reserve, one of their primary jobs is to keep inflation, keep money stable. So keep inflation relatively low. And they have different tools that they do that. They set the federal funds rate that banks pay each other to meet reserve requirements. And from those rates, other rates do tend to follow, not exactly and not, in uniform, but generally over the long term, yes. Because interest rates are of different instruments. Bonds like treasury bonds and mortgage-backed securities are all part of a marketplace. You've got people that want money, that need money to buy a house, for example, and you have people that have a lot of money that will invest it in mortgage-backed securities so that they can get a return on their investment. They can get interest, okay? And so when the Fed raises the federal funds rate, eventually over time, the other rates are going to go higher. The Fed also influences mortgage and treasury rates by directly investing in those markets. Okay, so here's your mortgage rates over time. And again, way back in the 80s, in response to the really high inflation, you could see mortgage rates were really high. Now they're back up to 7.5. Actually, I think the latest Mortgage News Daily was 7.92. So pretty high, but historically not all that high. But if we look at recent history, in the 2010s, after the foreclosure crisis, it was mostly under 5. And during the COVID crisis, it got down to 3 and even a little bit under 3 at a brief time period. Now, I want to point out that to get rates that low, the Federal Reserve did some extraordinary things, okay? First thing they did was they reduced the federal funds rate to 0. And that's kind of unprecedented, but they didn't do that until the financial crisis 2008, which was literally a financial meltdown practically. And they reduced that down to 0. Then again, after COVID, they went down to 0 on the federal funds rate. Okay, this is extraordinary measures by the Federal Reserve. The other extraordinary measures that the Fed did was they started buying mortgage-backed securities in huge numbers. They currently own about $2.5 trillion in mortgage-backed securities, right? And you can see the huge purchases in 2009-ish, in response to the financial crisis, again in around 2013, and then after COVID, huge purchases. This forced interest rates down. Okay. Now, the thing that I want to point out is the low rates that we had, the low mortgage rates we had over most of the last 12 years were intentionally pushed down by actions by the Federal Reserve. Okay. And what did it take to get them to take those actions? It took 3 decades of low inflation and then a major financial meltdown, the foreclosure crisis, right? And then another decade of low inflation and the COVID crisis. That's what it took to get mortgage rates down to 3, and even below 3. And I stress this because now that rates are higher, 7.5 plus, there may be people out there that think that rates are going to go back down into the 3s. And thinking about what happened and how much time passed, for the Fed to feel safe that, we're in a low inflationary environment. It was literally decades. Okay. And then 2 major crises, that's what it took to get rates that low. So the question is, what will it take to get rates that low again? And that's why I don't expect rates to go down that low again. This chart's pretty interesting. So on the left is interest rates. Down below would be Treasury bill terms. These lines are, the bottom one in light blue is June. And then above that, July, August, September, and then October 3rd in the dark blue. And the dots represent Treasury terms. Way on the left is the federal funds rate. And then working our way to the right, you got 1-year Treasuries, 2 years, 5 years, 7, 10, 20, and 30. Okay, the 10-year Treasuries are usually what we compare mortgages to. They usually track, pretty close. What's strange about this chart is that it's inverted. Normally, the longer terms are going to have higher rates. So if you're an investor, you're going to tie up your money for 10 years, you want a higher interest rate than like a 2-year or a 1-year. But in this chart, the 2 and the 1s are higher. And that's because we're in this unusual environment where the market believes that interest rates are going to be lower later. They believe that the Fed's going to start lowering rates. They believe the Fed actions will cause a recession or whatever, and rates are going to come down. So like back in June, they were comfortable accepting a 3.75 rate on a 10-year T-bill because they felt that's pretty good compared to what we might get next year or the year after. Okay. What has happened in the last 3.5 months is a huge realization of the market that interest rates are going to stay higher for longer than what we thought. So now you got the 10s at 4.75, still below the 2s. So the market still believes rates are going to come down, but not as fast and not as much as they thought before. And here's the spread between the 10-year Treasury bills and the mortgage rates. And historically, it's usually between 1.5% and 2%. Now it's up at about 3%. And again, just opinion here from a non-expert. But historically, people would keep their mortgages, like 5, 6, 7, 10 years or so. The belief now is that most people are going to be refinancing in 2 years. And so the investors that are investing money in mortgage-backed securities want a higher premium. So they want a bigger spread. So, and where are rates going to go in the future? We can all sit here and predict what the Fed's going to do, but let's look at what the Fed is predicting. Okay, so these little dots represent the Board of Governors of the Federal Reserve. And on the left, at the end of this year, they all predict the federal funds rate to be where it is, at about 5.25 to 5.5. The end of next year, about half of them are above 5, about half are below 5. So a little bit of relief in interest rates next year. The following year, by the end of 2025, it's really spread out, but most of them, it looks like, are under 4%. And then by the end of 2026, you've got a bunch of them down at around 2.5%. And same with the longer run projections, down around 2.5%. You still got some up in the 3s. So these are the predictions from the Fed governors as to where they're going to set the federal funds rate. Not a single one of these dots is down at zero, where we had for much of the recent past. So this chart shows affordability, and the higher points mean low affordability. This means that your monthly mortgage payment takes up a higher percent of your income. And way over on the right, currently, I think the number nationally is about 35 to 38%. So the median mortgage payment's about a huge percent of the income of people, not very affordable. So it's kind of like it was back in 2006 and like it was back in 1982 when interest rates were really high. So this shows the affordability challenge that we have now. And this does as well. So the line in blue would be mortgage payments over time nationally, and the line of red would be rent payments over time. And you can see how high the blue is shot up at the right, quite a bit above rent cost. One thing to keep in mind is that although it's not even track, but both of these over time go up. And so when you buy a home, like I did back in 1982, when it was at a peak at the time, and I got a subsidized rate at 11 7/8 when rates at the time were about 16, 17%. So my payment was a little bit less. It was 500 something. But then it stayed that way. Yeah, I owned it for 25 years, right? And it was only a few years later when the rental value was higher than, what I was paying on a monthly basis. Okay. So that's the thing about home ownership, is you kind of lock in that affordability, essentially. And I bought again in 2008, when it was still kind of high, and then I refinanced at a lower rate a few years later, 2011. So anyway, this is the current state. Also looking at affordability. We oftentimes compare prices, median prices, to median incomes. Median incomes include homeowners. We're at about 74% home ownership rate in Minnesota, but it's really these tenants that want to be first-time buyers, and the tenant incomes are quite a bit lower. And so on this chart in Minnesota, it calculates the income needed to afford a mortgage at about $116,000 and the median renter income at about $48,500. So this kind of demonstrates the extreme situation we're in. So let's look at some of the current data. Demand, as measured by sales, was before COVID a few years ago at near record highs at about 60,000 a year. And then it shot up during COVID with the extremely low rates up to about 67,000. And then it's just kind of fallen off the table, basically. So we'll end up this year at a little bit under 45,000. It's about a third of a drop off of where we were at that peak. This is another way to look at it. And you see the seasonality here, how demand peaks in the middle of the year. And the darker line on the bottom is this year. And the line immediately above it is last year. And you can see how sales dropped off dramatically when interest rates went up in the middle of last year. And this year, they're actually a little bit lower, but they're getting close to where they were last year, but nowhere near where they were a few years ago. New listings. So seller activity had actually been low for a number of years, which is part of the reason why inventory is low. And then again, it's dropped even lower. And so seller activity is down. Keep in mind that many sellers, most of them, would also be buyers, okay? And there may be a lot of people that want to move, but they bought recently or they refinanced recently, and they don't want to give up a 3% mortgage to get a 7.5% mortgage. So it's just, simple facts there. Another way to look at it, and you can see this year, we've actually just started to kind of cross over where we were last year, but we're still really low in seller activity as well. This leaves inventory of homes for sale, which has been historically low. It hit a bottom in early 2022, it started to go up a little bit, and then it's been dropping again. So this is the challenge that we have. This is what keeps prices from falling, the fact that there's a low supply. Now, if we measure this, this next chart will be similar, but not exactly. That last chart was just inventory, the number of inventory. This is the month supply, which factors in the demand. And here you can see at the end, it's actually rising a little bit, and that's because of the great drop off in demand. This is still at a level, 2 months of inventory, that is a strong seller's market, but because it's on the rise, it's not nearly as strong. So we see, underlying upward price pressure, but prices aren't going up that much. They're only about 2 to 3% above last year. This also shows the inflow, the relationship of current sales to current new listings. And this year is kind of at the bottom, a little bit under last year, still in seller market territory, but at about 75% compared to a few years ago at 90%. That's actually a big difference. It doesn't seem like much, but that's the difference between prices going up now between 2 and 3% versus going up at 10% or more per year. This chart I thought was interesting. Again, it's months supply going back just 5 years. And this breaks out houses and condos and townhouses. So all of them were in seller market territory, but the green, the townhouses, were in extreme seller market territory, selling very fast. And then condos in the middle, and then houses were selling not as fast as those two. As soon as COVID hit in 2020, and we had the shutdowns, you can see how condos in red became less popular and houses became very popular, as did townhomes. And what you had was, stay-at-home orders, everything closed. Much of our market of condos is in downtown Minneapolis or St. Paul or uptown. And a lot of the attraction was you're close, you're walking distance from all of these things that you can do, whether it's work or stadiums or theaters or nightclubs or what have you. And with all of that closed, the condos became less appealing. At the same time, everyone was working from home and needed more space. So there was a huge demand to buy houses and townhouses as well. So it's kind of an interesting chart. Here's prices going back about 18 years, and you see the big dip with the foreclosure crisis, and then it's just been steadily going up. In the last year or so, it's kind of flatlined. Again, we're at about 2 to 3% above last year. And this one I think is interesting. David Arbit shared this with me. Again, it breaks out the condos in the green on the top, townhomes in the red in the middle, single family in the blue down below. And this is the percent of sales that are cash sales. So way over in the right, recently we have an increase in cash sales, which makes complete sense because interest rates are so high. Okay, more people are using cash. What's really interesting to me is the condos have taken a kind of a steeper upward push than townhouses and single family homes. And we just don't have data to explain why, but I would just assume that more of the condo buyers are older, wanting, the one level living or what have you, with the low maintenance, and just have more money, baby boomers that have cash to pay versus younger people that have less cash to pay. Okay, let's look at some additional charts to give kind of a national perspective. One of the points that I want to make is that current homeowners are in a very healthy financial position. I think that although some people think prices may come down because of the extreme conditions that we're in, I think for prices to come down like they did in 2008 through 2011, what it took back then was a foreclosure crisis, a huge number of bank-owned foreclosures flooding the market at ever decreasing prices. And I think that the current situation of homeowners is very healthy, and it's very unlikely that we would see that kind of scenario. So we'll look at some charts to indicate that. This chart shows the interest rates that are out there now that homeowners have. So the bottom, the dark blue, is mortgages that are below 3%. Above that, the lighter blue, they're below 4%. And you combine those two, and you got 60% of all homeowners are below 4%. And then you throw in the gray, which is below 5%, and you got 80% of homeowners are below 5% interest rate. Okay, so that's a very, very good situation for them. This one shows equity, and the lower one in dark blue is the loan to values less than 60%. That means that the equity is over 40%. Okay, so 70% of people almost have more than 40% equity. And then above that is the over 30% equity, and the gray above that is over 20% equity. And we're looking at 90+% of homeowners are over 20% in equity. Okay. Very unlikely for people, even if they get into financial distress, to let their homes go back to the bank and give up their equity. Okay. So they may need to sell, but they're going to sell on their own before a foreclosure rather than letting it go back to the bank. Fortunately, not very many of them are in distress situations. This is the national delinquency rate, and as you can see over on the right, it's extremely low. So very low delinquency rates. This chart's kind of interesting to me, and it kind of measures, uses a couple things to measure vulnerability of the market. And on the left side, going higher, it's measuring household debt as a percent of disposable income. And on the bottom, it's within these countries, the percent of mortgages that are adjustable rates. Okay, so the safest place to be is in the lower left corner, which is exactly where the United States is. Basically, almost everyone has fixed rate mortgages here. And as we just looked, most of the fixed rate mortgages are really low interest rates. Many of the other countries, like look at Finland and Norway and Australia way on the right, they're mostly adjustable rate mortgages. So as rates have gone up, those house payments have gone way up recently. So they're much more vulnerable. And then we're in the lower end again. So, we've got about 100 household debt's about 100% of our gross income, which is kind of high, but we're in the lower range like Germany, Spain, Italy, and Austria. So essentially a pretty healthy place. This is part of the reason why we have a low inventory of housing and why we're just woefully unprepared for the large number of millennial generations that want to become homeowners. So if we go way, way back to 1971, 72, we can see that housing starts were about 1.2% of the population. Okay. And you can see, yes, it goes up and down based on, recessions and other factors. But the general trend has been down. And in particular, starting around 2006, 2007, it really dropped off dramatically. And it's not come up very high. It's only up at about 0.5% of the population. Okay. So we have underproduced housing, especially lately, and at a time when we need more housing because there's so many people, entering into that home buying age range. What makes matters worse is that this chart measures the housing as compared to population. But the other thing about the population is that household size has been getting smaller over time. So with a given equal amount of population, there's actually more of a household need because there's many more people that are living on their own, for example. So we're just simply not meeting the demand. Here's some projections for 2024, and you can see over on the right, projections for housing prices from CoreLogic, Fannie Mae, Freddie Mac, Mortgage Bankers Association, and Zillow, ranging from about just under 1% up to about 4.9% increases in house prices for next year. Here's some risks that I pointed out, and in the long run, everything is a risk, right? So this I'm thinking like in the next year or two. So again, entirely opinion here. But risk of recession, I would say, is moderate. Risk of a lot of foreclosures, I would say, is low. Risk of financially distressed sellers, if we get a recession, then for sure there's going to be some. So I'm saying low to moderate. The risk of a downturn in sales, we already have a downturn in sales that's huge, right? But I would say the risk of an additional downturn is moderate. The risk of a significant increase in inventory, I would say, is low. The risk of a decline in inventory, even though we're already low, I would say is moderate. A risk of a decline in prices is low. Risk of rising prices is medium. And why would that be a risk? Well, that makes things less affordable. The risk of increasing affordability, which is actually a good thing. But from a realtor perspective, if people are thinking that affordability is going to be better, then they're more likely to wait. And it might not be in their best interest to wait. Anyway, I think that's likely, increasing affordability. And I think mostly because interest rates will ease down a little bit. And then incomes at the same time, incomes will go up. I don't think this is going to be a situation where prices are going to come down much. So here's some summary points. The inflation impact on rates, I think, will last longer than we expected. And as I showed on that one chart, the market's starting to realize that as well. So we've got low affordability, which puts a ceiling on prices, prevents prices from going up too high, versus low inventory, which prevents prices from going much lower. And so prices are kind of flatlining now. Boomers and millennials, owners and buyers, there's just a vast difference. You know, those that are owning property right now are usually in a really healthy situation. They've got a, pretty affordable payment. Those that want to buy are looking at a very daunting situation where, to buy a house now, your monthly payment might be $3,000 plus, where 2 years ago, it might have been $2,000. So it's just a huge difference. There's a long-standing new construction shortage, especially of affordable housing. And then there's the lock-in effect of high interest rates, people that might want to sell or move, but are unwilling to give up a 3% mortgage to get a 7.5% mortgage. Finally, I've got a quote from NAR that I pretty much agree with. Once mortgage rates eventually drop, which NAR is largely predicting will happen sometime next year, substantial pent-up demand in the housing market will be unleashed. I generally agree with this, although I think the unleashing will be a little bit slower. Or it might be kind of like, imagine if you unleash a dog and the dog then takes off running as fast as he can, okay? Or you unleash another dog and they might be like, okay, I'm free, but let's kind of take it slow and easy and see how things are, and then move kind of slowly. I think that might be more like what will happen. More people will be able to get into the housing market as rates come down. I don't think they're going to come down anywhere near like where they were before, maybe into the 6s this next year, and then into the 5s maybe the year after. And they'll start to kind of drip into the market. I think the demand and things will pick up. So at this point, I'm going to do my stop screen share, and I'm going to let Jackson take over with his part of the presentation.
Great job, Pat. Can you hear me all right, everybody?
You
Yes.
are on.
Wonderful. I will go ahead and share my screen now. I'll share screen number 2 for you guys.
And it worked.
There we are. Well, hi, everybody. Like Pat and Carson said, my name is Jackson Pino. I am the Public Affairs Manager for Minneapolis Area Realtors. Part of my duties also include being part of our research team, which means, like Carson mentioned, I get to be a numbers nerd with all of you today. The main focus that I'm going to have here is big picture, with the tone of that being end of year, third quarter just finished up in 2023. But let's start things off with highlighting September, our most recent month. We're going to go through all the major metrics that I pay attention to, Pat and Carson pay attention to, and we think you should be paying attention to as well. Jumping right in now to September closed sales. Now, Pat, you did mention, you used the phrase downturn towards the end of your presentation. I think that for you and other practitioners in this space, you're definitely feeling the weight, right, of a downturn. I want to propose something a little bit more optimistic, right? With the phrase correction. A lot of the charts that you're going to see here will resonate with that feeling of, yeah, it's not as good as it once was in a few years prior. And September's closed sales are exactly that. As you can see in our rightmost bar here, we finished September with just over 4,000 closed sales. That's 16% down from just short of 5,000 in 2022. And as you seem to go back, that's 4 straight Septembers of decreased buyer activity, right? You say downturn, I say correction. And I'm going to take a moment here on this first slide to kind of show you why, right? My pen tool here, if we can see it. These 4 previous years from 2016 through 2019 were relatively flat. There was a little bit of variance there, right? But we shot up in 2020 because of the COVID-19 pandemic and the run on inflation and buying activity that happened because of it, right? Now let's just take that line and go right across. We had a peak and a correction. That is what I'm seeing. Positive above that horizontal, that crudely drawn horizontal line, and then a reaction to it. Ideally, if the Fed is doing their job correctly, we're going to come back out of it. We're just in the deepest part of that correction. So I want to caution people against the use of downturn. I think you're totally legitimate in saying it, Pat. I don't want to, push the issue too hard on it. I just want to at least encourage a sense of optimism and a step back from being in that field, what you all are probably feeling on a day-to-day basis, and view the market dynamics from a larger 50,000 point view. Fair? All right, let's jump in. I'm going to clear all of this right now. And yes, so we are down. This is the 4th down September, down 16.3% from last year. And no doubt, Pat and Carson, that you must be feeling that, as are many of you watching this video, right? And so are sellers, right? Because for all of the lacking buyer activity from years past, sellers who are reluctant to put their home on the market are reluctant to do so because they also need to potentially be a buyer, which is why you are seeing that similar 4-year slump from a height of just short of 8,000 in September of 2020 down to this most completed year of 2023, 5,700, 5% down from last year, and noticeably down from that high of 2020. Similar correction of what we're seeing here, and that is because of that downturn, that softening. I'm going to choose to say from this point on, softening buyer activity that we saw in that first slide. Another way to look at this is the ratio of pending sales to new listings. Think of this as an indicator of how hot the market was in each of these given months of September. 85% is what we were seeing in that height of 2020. That means 80 out of all new listings, the number of new listings, the number of pending sales were 85% of that. We had a almost full replacement of homes going under contract versus the homes that were put into the marketplace in that month. And yes, we have gone down, but you can see proportionally here that that downward slump is not as dramatic as it was in the past 2 slides, right? We're at 64.5% right now in September, which is still lower than it was, right? But that gap between the 64.5% in this month of September isn't as dramatic as it was in the previous slides compared to previous ratios of pending sales to new listings prior to the COVID-19 pandemic, right? Where they're somewhere hovering around the low 70s, save for 2017, because of the federal tax bill that happened at that time, right? So I hope that gives a picture of the balance of supply and demand for you from a larger perspective, at least for the months of September, right? Let's look at another great indicator of the market in terms of market performance and how quickly the market moves. September's median cumulative days on market, CDOM. And this is our median, i.e. half of all homes in the month of September sold in under 17 days. That's 10.5% down from 19 days last year. But as you can see, we were on a different type of downwards trajectory, right? This type of downwards trajectory indicates that the market has been speeding up really ever since 2014, a faster and faster market until we hit the frenzy of 2020, where we were down to a median of 12 days on market. We have since had a bit of an uptick, right? That is because of that softening buyer activity. There are fewer people rushing to purchase homes quickly, purchase homes over asking price, right? We are now starting to level off, at least in the perspective of the last 4 years. September median sales price, another key metric that everyone is paying attention to. How much is the median cost of homes in the Twin Cities, right? We are at $371,000. That is 2.4% above what we had last year. And as you can see, that's still positive price growth, right? That price growth is, we are seeing price growth, but not at the same rates as what we were seeing in 2019 to 2020, 2020 to 2021. And I don't foresee us getting to the point of double-digit price growth anytime soon, especially with that softening buyer activity. The silver lining in all of this is that for the most part, 2023 has seen, smaller price growth, but not decreases in median sales price. There were a few months where we were level. There was one month in particular where we were down marginally, but on the whole, we are still marginally increasing from year over year throughout most of the months. And that's not bad for a recovery year. Let's look at September percent of original list price, the percentile amount or percentage amount that people are offering over that original price listed, right? And you can see that we had a generally increasing percent of original list price that people were asking closer and closer to that original list price going up into the pandemic for the month of September, but just short of it. And then the pandemic hit, and then all of a sudden people were asking a little bit over asking price. And then in 2021, it was 1.2% over original asking price, right? And we have had that correction. We're experiencing that correction back to what we were seeing similar, and in some ways, just barely above what we were seeing pre-2020. And then finally, the last focus I want to have here with these monthly charts is inventory and then month supply of inventory. Pat, you already kind of mentioned this, so I'm not going to belabor the point here, but yes, we are at an inventory shortage. That is part of why our month supply, our median sales price has not dropped as it has in other markets across the country. We have had, whether you want to see it as a positive and negative, can be debated, but we didn't see the sharp spike in buyer activity that some of our coastal cities saw in the pandemic. But because of that, we aren't seeing the huge drop-offs either relatively. We're seeing some, softening in buyer activity. We're seeing that slump that I've indicated in the beginning, but it's not as dramatic as other markets in the United States are seeing, right? And because of that, month supply of inventory is still strongly a seller's market, right? We were at a low month supply of inventory of about a month and a half in 2021. That was as far as this chart shows, since we've been keeping record, a low of the height of the demand was far exceeding what was considered a balanced market of 4 to 6 months supply. We are starting to increase up to 2.5-ish months supply of inventory. That's 18.5% on what we saw last year. And again, that is mostly due to that softening buyer activity, not necessarily because of a dramatic increase in inventory. So I said that I would mention a quarterly update. We are now in the 4th financial quarter, and now is a great time to get, in some ways, a sneak peek of how the year might end up. Because as many of us know, the final financial quarter in real estate tends to not be as productive because of seasonal preferences in purchasing choices, right? There are some exceptions to that, but for the most part, this is a good way of getting that sneak peek of how the year might end up, right? And the story is fairly similar, right? I'm not going to go through the drawing again, but you can see September year-to-date numbers are down meaningfully from 2023 to 2022, 2022 to 2021. That is expected. I think we all anticipated 2023 to be a rebuilding year. Now, again, there is going to still be some growth from each of these charts. So all of the 2023 bars that I'm going to be showing you are deflated, so to speak. They're missing that final financial quarter. They're going to be increasing. The question is how much? How much of this catch up can we do being 20% down right now relative to the 3 quarters of last year, of the year before, and so on, right? So moving into new listings, yes, we are down 15.5% at just about 48,000 homes sold so far, or listed so far this year. Median sales price, again, you can kind of see the impact of the more flat or marginally down median sales price months that I was indicating earlier. We are just marginally above 1.5% increase over last year at about $370,000 median sales price throughout the year of all homes sold. Average percent of original list price is, again, 99.8%. It's just under that threshold of asking price of that original listing price. And then days on market, similar story of what we were seeing, 17 days, and that's a median cumulative days on market. So half of homes are selling under that 17-day threshold. That's up 42% from last year. Similar stories of what we were seeing in the month. September seems to be fairly representative, but keep in mind that these numbers will grow and will marginally change as we get closer to the end of the year. Happy to answer any questions. That's the end of my slides. Do we have anything in the chat, Pat and Carson?
I don't see anything in the chat. Thank you, Jackson. That again, I love getting the different perspective from you and the different charts that you're able to pull up that we can't get on InfoSparks. This is always appreciated as well.
Of course.
Well, and it sometimes is more interesting if we can have some live comments or questions. Does anyone have anything they'd like to bring up or ask these gentlemen?
We can absolutely open it up.
Yeah.
It doesn't have to be. We've got a smaller group today. It doesn't have to be on the chat.
And if we don't have a question, I'll kick things off because I feel like I called you out a little bit, Pat, in the beginning. What are your initial thoughts to that correction perspective that I brought in versus your downturn conversation? I mean, I'm not buying and selling real estate, so I'm not feeling it like you are. So I wanna give you a ability to respond to my comments on that.
Well, we're really both looking at the same thing. So we're just using different terminology. And I don't know that I don't think either of them is really incorrect. So like when I say downturn, obviously it's a huge downturn from the high level of sales that occurred during COVID, like late 2020 through early 2022, which I think were pushed up kind of artificially by those super low interest rates. And so correction is a really good term to use in the sense that those were almost like bubble level of sales, kind of like an inflated number of sales. So correction is a really good term to use there. But I think downturn is a good term to use as well. So we've dropped off like a third from that peak in 2021 in sales. But if you look at the pre-COVID, we had several years where we were at around 60,000 a year in sales, which I think is maybe a little bit more normal, even though granted, those rates were pretty low as well, those interest rates, with the actions of the Fed. But we were getting used to that, and we're still below that, so it's still kind of like a downturn. I think is okay to use.
Fair.
Correction is okay. I think they're both fine.
Yes.
And yeah, and it's great to get the perspective of, myself. I'm out in the field working, and then your perspective, from the data analytics, the public policy perspective.
Yeah. And I will fully admit, being separated from the practice, there tends to be less emotion in some of the analysis that I use, right? But this is an emotional business in many ways. I mean, you all know this. You're helping people make the biggest financial transactions in their lifetime. You're helping them make life-changing decisions in both good and bad ways. And when you have a life-changing market event like the pandemic, that is emotional. So I think you're totally justified in that perspective of saying it. I think it's great in these sorts of venues to really encourage that exchange of different perspectives, because the insights that you have, I learned from. Absolutely.
Well, and Jackson, I have heard anecdotally from so many realtors say, well, this year it's going to all come to a stop and there won't be any business. And here I'm feeling the emotion of writing 4 or 5 and 6 offers for more than one buyer that have not been accepted.
Yeah.
And so that's.
I'm going to bring up a couple of things that I find interesting. One of them is a historical perspective. So you may remember the chart that I showed that affordability is, very low, but the chart shows high as in, the monthly payments that people are paying as a high share of their income now, similar to like back in 2006 before the market crashed, and then similar to 1982. And what I want to point out is that back during those times, there were some remedies that people were using. In 2005, 2006, as the payments got really high with prices going high, a lot of people were using those bad subprime loans that came out with very low teaser rates to be able to qualify to buy a home. It ended up not working out well for them, but it was a way that we kept on selling houses, essentially, a method that doesn't exist now. Back in 1982 and 1981, when mortgage rates were 17%, 16, 17%, I looked at sales data back then, and we had like 2/3 of the sales during those 2 years were assumable mortgages or contract for deed financing, where people were taking over payments from someone else's mortgage, which at that time they were assumable without qualifying. And so you could take over payments of someone's 7 or 8% mortgage, and then maybe do a contract for deed for part of the difference. And 2/3 of all the sales were done that way when the rates were that high. So again, it was another technique to make things more affordable. Both of those techniques don't exist now, except I should say that you can assume mortgages now, FHA and VA, but you have to qualify.
Mhm.
And there just aren't as many of them. Back in those days, most of the mortgages were FHA or VA. Now it's a much smaller percentage, but this is a pro tip for some of the realtors here. If you do a search in 2018, 2019 of all the FHA sales, you got a whole list of people there that have a tool to sell their home at a lower interest rate. Now, maybe they don't want to sell, but that's just an option that's out there that I wanted to mention. One other thing on a completely different subject I want to state is that we're trying to work on ways to make things more affordable. So, we got Natasha Rice on the call here with the Congresswoman Omar's office. And at the federal level, we're trying to do things to spur supply, increase supply. And I've talked with Natasha and the Congresswoman and plan to again next week about the idea of a tax credit. We've forever and ever, we've had tax mortgage interest deductions, but it just doesn't work as well anymore with the standard deduction being higher. So a tax credit might help as well. But also at the same time now, NAR, the National Association of Realtors, is trying to persuade the governmental officials and the Federal Reserve to maybe start purchasing at least enough mortgage-backed securities to replace the ones that are dropping off their balance sheet. That would reduce the spread and bring mortgage rates down quite a bit. And also maybe some policy changes the government can make to allow Fannie Mae and Freddie Mac to start purchasing some of their mortgage-backed securities. That would help reduce interest rates. So we're working on this stuff very hard to try to find a way to ease things. So at that point, does anyone have any questions?
I was hoping we could have feedback from a lender on the call here, but wow, even Jerry's being quiet.
Don't sound so shocked.
Well, we appreciate everyone who did join in and
Totally appreciate everyone.
sharing the story, and these discussions are always beneficial from my perspective. It is recorded on YouTube and viewable again in that venue, and we'll be back again at the end of fourth quarter, which brings us to the early to mid part of January for the next Pat Stats. That's hard to believe we're talking about that, and we'll see if we're gritting our teeth, Jackson, or if we're seeing things getting better, because it's a typically slower time of year to begin with, but inventory and a lot of the stats that we're looking at, it may be a little slower time.
I'll just leave you all with 2024 is going to be a more positive year. So
I believe that as
there's
well.
light at the end of the tunnel. It's just how far away is that light?
Well, and I'm with you. I don't think the interest rates are going to creep further up. I think they're going to moderate. And I keep hearing that comment from Dr. Lawrence Yoon that our mortgage rates typically settle in after a period of time at about 2 points below the Fed rate, and that would be lovely.
I'll also add in, since I was too quiet. I'll also add in that I think the more that the 3% and 4% interest rates go into our rearview mirror, the better off we are, so that people stop waiting for this. As time goes on, I think now the people that were waiting for 3 or 4 are now waiting for 5 or 6.
Yeah.
And I think that will have a much bigger impact now if we do hit, I mean, I think some point we will get 6, but the economists who have a lot more information than me haven't been right, so I don't know why I would be right on it. But at some point, I think that we will get to that number. I just don't know when.
Well, and in the policy world, which we so far still have in place, people get a tax deduction that we didn't have any reason to discuss with a 2.75% interest rate. And so there are some pieces to the story. It all balances out. So thank you, Jackson, for your optimism, and Pat for your stats and balanced look at the data, and everyone for joining. So we appreciate it, and we'll see you again next time.
Thanks,
Take care,
guys.
everybody.
All right.
Thank you all so very much.
Thank you.
So